Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, March 12, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we have a couple of things to discuss today, so let's get right into the action. We had an interesting day. We had a slight gap higher in the market today. However, you'll note where we finished. On the daily chart, the important level that we've been discussing, and that's been a red line across the screen, has been 278.80. That's an important level. It also coincides with another important level where the 278.92 pivot high from the 27th of February also is in that range. Now, what you'll note is on Friday, we finished right up against that. We finished at a high. The close was 278.87. So above the red line, but slightly below the pivot high from February 27th. Now, it sounds like I'm splitting hairs. It sounds like a penny here, a penny there. What difference does it make? But this is the way the market works. The market respects certain numbers, and when we close above or close below certain numbers, it is important on the charts, and it gives us an indication of what the next likely move is going to be, whether it's taking a bullish stance or taking a bearish stance in the market. So those numbers are important. So let's talk through numbers for just a minute. Today's close was below the red line, 278.54. So we popped above it in the regular market session, but the close is what's ultra important. And you can see here that we gapped higher, we dipped below it, and we traded around that number at 278.80 all day long. So that number was important to me a long time ago, and it seems to be important to the market, at least for today. We dipped below it in the afternoon session, tried to rally back above it, and did not close above it. And here's what's important, okay? When they want to close the market above a certain number, it's very easy for them to do, especially on days when there's relatively light volume. We had about 65 million shares traded in the Spider today, and that is relatively light volume. You'll notice that of that number, about a little more than 6 million shares comes in the last candle of the day. We saw the same thing on Friday, where about 10 million shares came in the last candle of the day. That happens each and every day, every single day. The first and the last candles typically are, and these are 10-minute candles, typically are the heaviest volume days of the session. Now let's go back to the daily chart for a second, because there is a method to the madness. There's a reason why all these things are important. Let's talk about where we stand in terms of the S&P 500, or in this case, the Spider chart. Are we bullish or are we bearish? Well, the bigger picture is we're really bullish because we're above all the moving averages. That means the trend has turned up. We had a sell-off in February, and the trend was down up until the point when we got above, the moving averages. That was the first indication that the trend was turning back up. And then when we got above that triangle pattern that we had been looking at for a few days, we got above that on Friday with that huge surge above after the phony jobs number. That really turned the trend back to the upward direction. So here we are, struggling to get above the 278.80 level. That's an important level. The real number also is the high, 278.92. If we close above 278.92, that's going to also be bullish for the market, but we do have other areas that are important and that will provide resistance to the market, namely 281.07. That's a gap fill area. You have another gap up here, and then you have the all-time highs. So here's what I think are the possibilities over the next several days. Now keep in mind, this week is options expiration week. It's also quadruple witching options expiration week. That's found on the quarter. So the March quarter closes this month, and therefore 4 times a year on the quarter is quadruple witching options expiration week. What is that? That's when 4 asset classes are expiring in terms of the options. There's also a significant rebalancing that goes on during quadruple witching options expiration week. So look for a lot of volume to come into the market this coming Friday towards the end of the day typically. So here are some options that I see as real likely scenarios over the next few days. So number one is we can just go sideways in this upper range here. And if we do go sideways, that's the market's way of telling us that it's building energy, eating time off the clock, letting the moving averages, namely the 20-period moving average, or what we like to call home base, come up towards price. And once they work some time off the clock, build some energy, that means that another move higher is likely coming. That's one scenario, and that is a likely scenario. That can certainly happen. Don't rule that out. Another scenario is that we can come back towards this downsloping trend line, towards this upper trend line that we had drawn in. We can come back and sell off a little more in the market, and if we test the upside or the top side of this downsloping trend line and that holds, that'll have the same effect as if we just go sideways. That'll be the market's way of eating some time off the clock, letting home base come up towards price, and if this upper trend line holds, that can mean another move to the upside. That's the second scenario. So scenarios A and B are really the same, meaning they're really bullish pullback or sideways patterns that can mean another higher move or another bullish move in the market. Now the third scenario is if we got back below this trend line and closed below this trend line, that's going to be a bearish sign for the market, and that will likely mean lower prices coming in the near term. So what do you do with that information? Well, number one is if you see the market just go sideways in a very narrow range for the next several days, that's going to be an indication that the market's building energy for another push higher. So if we go sideways for, let's say, 3 or 4 days, we get to the end of the week, and all we've done is go sideways in what's called a bull flag pattern. And a bull flag pattern would be you have this up move here, and then we just go sideways and it develops a flag pattern. That will typically result in another move higher. So you can wait a few days, see if that begins to develop, and then you can hop on for another move higher. The second item is if we move lower and this upper trend line holds, that's another area where you can also wait for that trend line, and if we test that trend line and begin to bounce off higher off that trend line, again, you can play that to the upside for another move higher. If the trend line doesn't hold, that's typically going to mean lower prices are coming. We'll talk about that if and when that does take place. And if that does take place, I'll have areas on the downside where we're likely to find support. We can't really determine that just yet because we don't have enough evidence. We don't have enough of a pattern in place to say, here's where the downside would be, here's where support would be if we broke this trend line. I would have to see the market trade for a little bit of time and see what kind of velocity we might come down beneath that trend line in order to determine where the support levels are likely to be. And by the way, in terms of resistance levels that we just spoke about, in terms of the patterns that we keep talking about, all these things are discussed in the course at lazyeMinitrader.com. And what's interesting is, if you want to click on the link below this video, you have an opportunity to see 3 of the lessons in the course. I give you 3 of the real lessons from the course. Now, it's not the total course, and some of the lessons are going to be a little bit foreign, maybe a little bit obscure to folks that aren't familiar with how I analyze and forecast in the markets. However, they're certainly going to be helpful, and you'll get a flavor for A, my teaching style, and B, the type of content that's found in the course. Keep in mind that each and every lesson in the course builds on the prior lessons. There's just a ton of information. It's a library of information in this course, and it teaches basically everything I know and everything I use on a daily basis in order to analyze and forecast in the markets and give me an indication, whether it's at an intraday basis or a longer-term swing trading basis, what the next likely move is for the markets. Mainly, it gives us an idea of where we can go on the upside, where we can go on the downside, and also keeps us out of trouble because we know where we're wrong. And that's one of the most important things that traders can learn, is identifying areas when they're in a trade or thinking of entering a trade where they're wrong, and that enables them to lose small and fast, which is a very large component of how to make money in this business. You keep your losers small and you let your winners run, and that's how you make money in this business. So net, we had a pretty flat day in the Spider and the S&P 500. The S&P 500 finished down 3.5 points. The Spiders finished down slightly. So no big deal. It was basically a flat day, and that's not unexpected from Friday's big up move. It's likely after big moves like that, whether they're on the up or the downside, that the market takes a breather the next day. That's common and normal market behavior. Speaking of which, here's the IWM. And what you'll notice is we have the makings, or we have a doji candle in the IWM. Now the IWM was up 43 cents today, up about 0.25%. But we do have a doji candle, and we have been up from the last pivot low down in this area here. We have been up 6 or 7 days in a row for the most part, minus one little down day here, but that was no big deal. So from down here, we're up 6, 7 days, and that's generally an area or generally a time frame where we're going to be looking for the market to either begin going sideways or even pull back some. So it coincides with the discussion we just had in the Spider chart. So in the IWM, watching it very closely, certainly had a better performance day than the Spider did, but not by much, so we're not going to make too much out of an up day of 43 cents in the IWM. Let's take a look also at the VIX. Now you'll notice in the VIX that we were up today almost 8% in the VIX. Now granted, the Dow was down 157 points today, but the NASDAQ composite was up, the Spiders were flat, the broker-dealers were basically flat, so you had kind of a potpourri of information in terms of markets out there today. Some were up, some were down, but the VIX was up almost 8%. Is that going to be something foretelling of what's to come during this week? It could be. So I'm watching very closely, and this is how we put the pieces to the puzzle together. We take each and every market independent of one another. We put the pieces to the puzzle on the table, and then we try and put it together, and it gives us a picture of what the most likely scenario is going forward. The transports. So my second favorite leading indicator, the IWM, is number 1. The transports are number 2, down 1/3%. And you can see what happened here. Friday, we traded right up into, on that big up day, right into the 50-period moving average. That's the blue trend line. And today, we stalled out right up there. And now the question is, same as the other markets, are we going to go sideways or are we going to pull back? And that'll tell us a lot over the coming days. The line in the sand in the transports from this point forward over the next several days is going to be the low from Friday, 10,511.02. If we come down below and close below that level, that'll be very bearish for the transports. If we go sideways and we stay above that level, that's bullish, and that will be the market's way or the transport's way of telling us that it's building energy to go higher yet again and get through the 50-period moving average where it got stopped short on Friday. We'll take a look at the Qs again. I do have some traders that like when I go over the Qs, so I'll try and do it as much as I can. And you know, my feeling about the Qs is the index is top heavy on some of the big tech stocks, which is why I don't go over it all the time, but I do look at the Qs, and here's the reason why. When you take the Qs or the NASDAQ market as a whole, the NASDAQ composite or the Qs, either way, and you couple that with the IWM, when those two markets are surging upward, that means that money is not afraid of risk. So those are your risk indexes. They don't pay dividends. That's where money goes when they're willing to take risk. Hedge funds, mutual funds, whoever it is, individual investors, that's where money goes when they're looking to take risk because they want growth from the assets. So I'm looking at the Qs and I see what I can determine as, or what I like to call, a pseudo doji candle. And it's not necessarily an end-all be-all, but this candle, I like to call them pseudo doji candles. It's not a doji, but it's close. We're at highs, and these type of candles are more meaningful when they're at highs. However, I would have liked to see a bigger range today and finishing in the middle of a range. That's the market's way of telling you that it's a signal of a trend change. It's indecision in the market. Maybe we had a surge higher, but the market finished close to the open, and that's definitely, more often than not, an indication that it's a signal of a trend change. However, today's day was somewhat of a narrow-ranging day, so it's really not the greatest pseudo-doji, as I like to call it, but nevertheless, it is something that I want to watch closely in the coming days. Any close above today's high, and that's just bullish, no two ways about it. If we begin to go sideways, same story as the other markets I discussed. That could be the market's way of telling us that it wants to go higher, or we could certainly sell off. And then we're going to use the spider chart and that trend line as a line in the sand. If we can stay above that trend line, it'll still be a bullish pullback pattern. If we get below that trend line, that'll be something else going on. Now, before we move on to some of the other markets, namely gold and oil, I do want to make mention of something else. This is a good little lesson. We'll see how it pans out over the coming days. Here's a chart of Micron technology. Now, Micron has been a monster mover this year. Basically, ever since the February lows on the 9th of February, making a low of $37.52, and here we are today, over $60, finishing at $59.37. But here's the point I want to make. First, let's take a look at the volume on Micron today. 137.5 million shares against an average daily volume of 46 million. Now, when I see that, the first thing that comes into my mind is that's a potential exhaustion day. You can see that the trend is obviously up, so I'm not looking for a collapse in this stock by any means, but we are extended from home base. Home base is at $48.36. That's the 20-period moving average. So we're very far extended from home base. We have the makings of an exhaustion day. The stock was up 9% today, but it was up more earlier. We got over $60 a share. In fact, the high today was $61.17, and then we backed off. So when you take a look at the hourly chart, for example, you can see here that we went up for a few hours, and then we began to back off. You look at the intraday 10-minute chart, you can see here we put in one of those pseudo-doji candles, and then the market took it as a signal of a trend change, and we began to trade sideways to lower for the remainder of the day. And there's your signal of a trend change on the intraday 10-minute chart. But here's the other thing that I want to make mention of. Take the fact that we had tremendous volume today. And you have to go back in time. I don't even know when the last time we had 137 million shares in Micron. However, it's the makings of an exhaustion day. And what that means is that we have a big up day on volume, and typically that could be the signal or sign of the end of a move, not new bullish behavior. It could be new bullish behavior, and the way we tell that is if we were to get a close above today's high, then it wasn't an exhaustion day, and there are higher prices coming, but the high of today is not that far away from where price is right now. It's a couple of dollars away. Not even, it's less than $2 away. But here's the other thing, and this is what you want to pay attention to. An analyst today came out and upgraded the stock to $100 a share from his previous price target of $55 a share. You can look it up on your own. I believe the analyst was from Nomura Securities. But the point is that why would an analyst upgrade the stock at an all-time high? It's unlikely that a stock like this is going to keep going to 100 without having to, at minimum, of consolidate or pull back first. My point is, they do this all the time. They downgrade stocks at lows and they upgrade them at highs. Where was he when the stock was $48 a share with a $55 price target? Why wasn't he upgrading it then? It was only a couple of weeks ago. The point that I want to make is, pay close attention when you see stuff like that. The last thing you want to do is hop on a stock at all-time highs on an upgrade on a tremendous high volume day. It's typically an exhaustion day. It could certainly go higher, but more times than not, probably at least 8 out of 10 times, when you have volume like this against the daily average volume, you're going to see a stock pull back from these levels and have it be an exhaustion day. And here we have an analyst that upgrades the stock from 55 to 100 on an exhaustion day. Now, granted, he did it before the trading began, so he did it either over the weekend or early this morning, either way. So I'm not saying he did that after the high volume day and after it was already up 9%. But what I'm saying is he upgraded the stock to $100 at an all-time high. My point is it's unlikely to keep going from here. It's likely to have a pullback. We're far extended from home base. Stocks really just don't stay this extended from home base for that long of a period of time. Could it go higher? Yes. If we close above today's high, then I'm wrong and we can go higher. I think it's just unlikely. So I just wanted to point that out. It's a nice little lesson in looking at the charts and seeing how you put volume together with price at highs. It's not easy to pick a high on a stock for sure. But when you see a big up day on volume, that's at least an area where you can say the stock is likely to stall out here rather than keep going. The gold market. We didn't have much going on today in the gold market. The market was basically flat for the most part, so we don't have any new information. The same information holds true. We're in the middle of a range. We're sandwiched in between the 50 and the 20 period moving average on the upside. That's the blue and the red trend line. And the purple line is the 100-day moving average. And until and unless we go in one direction or another, we're not going to get a clear picture. We don't have a pattern to play off of. We just don't have a clear picture of which way gold wants to go. So when we don't have a clear picture, we just leave it alone, move on to something else until the picture clears up. So we can look at crude oil. Crude was down 70 cents today, or a little over 1%. So we're now back below the 20 period moving average. We had a nice big up day on Friday, but until and unless we can get back above the 50 period moving average, then the pivot high from the 6th of March, and then 64, it has a lot of work to do on the upside. Until and unless that happens, then the pressure is going to be either to slightly to the downside, or it could potentially be just eating some time off the clock, getting ready for another push higher, because we still could have the makings of an ABC pattern. And if we get above on a closing basis, if we close a daily chart above 64, that's going to be very bullish for crude oil, but it's got some work to do to get up there. Again, we're really in the middle of a range, and we don't have a clear picture similar to gold. Not a lot to do here. Here's your range on the downside. Here's your range right now on the upside, and we're right in the middle of that range. So it's very difficult to get a clear read in the middle of a range without a pattern that's telling us what the next likely move is for crude oil. And with that, folks, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.